Let's stay with the banks because the global financial crisis was one of the most devastating economic events in history, but not for Australia's banks. After sailing through the trauma, they've emerged in a much more dominant position. But nothing lasts forever, and there are very good reasons to be wary of the bank's $1.6 trillion exposures to Australia's hot property sector in the big cities. With the second part of our property special, here's finance correspondent Philip Lasker.
There's nothing more precious to Lubna Aki than her children.
Can you write 1 to 20, please?
But owning your own home with the added benefit of tax-free capital gains comes second. That means repaying the mortgage is a top priority.
If I want to have my own place, if I have to cut back something, definitely I will, because I don't want to rent for whole life.
It's an attitude that makes mortgages a safer bet for banks. But there's another compelling attraction for lenders.
Really profitable. I mean, as far as I can work out, the return on equity could be anywhere between 40 to 70%.
A Federal Reserve Bank of San Francisco working paper shows lending to Australian households has grown more strongly than any other developed country over the past 50 years. Between 1960 and 2010, the average increase in lending for the 17 developed countries was 55% of GDP for real estate. In Australia, the increase for property was 70%. It's that level of concentration that has the OECD concerned, because Australian banks borrow a lot of money from foreigners using the backing of their massive home loan portfolios.
Whenever you see concentration and whenever you see the securitisation of a certain set of assets being used as a sort of a funding device, then you have to worry about, whether there could be problems in rolling over those securities in the future under different sort of scenarios for the economy.
It's one reason Financial Services Inquiry Chairman David Murray has called for tougher capital requirements, a move resisted by the banks, which say it'll stunt profits and raise costs to consumers.
Well, have a look at the United States. It's done a lot more things, and I think that's serving the United States economy well. You can't have a too well capitalised banks.
The OECD says regulators should no longer accept the bank's own risk assessments of their portfolios. Instead, it wants the banks to hold at least 5% in unweighted, high-quality equity against total assets in the banking system.
And Australian banks, especially the major ones, they don't look as good as some other countries in terms of that.
Bank analyst Brian Johnson suggests any sort of self-assessment is fraught with danger.
I've been a bank analyst for a long time, and I've never ever seen a bank accurately forecast that there would ever be a problem anywhere.
There's a global move to raise capital requirements, especially for housing loans. Despite that, Australian banks are now holding less capital against their home mortgages than before the GFC hit.
There's this hyper rally that you've seen in Australian bank equity over the last 3 or 4 years has been accompanied by banks basically constantly reducing the amount of capital they have in respect of a home loan.
That'll have to change, but in the meantime there are many, like consultants Deloitte, who remain relaxed and comfortable.
The bank's lending criteria recently has been very strong, and the average loan-to-value ratios are still well less than 80%.
But analyst Martin North says the trigger for serious banking stress may come from the second-round impacts of households and businesses struggling in a difficult economy.
Those economic impacts will have a feedback into the broader economy, which in turn will have a feedback into the banking system.
And then there is the uncertainty surrounding the behaviour of Australia's army of negatively geared investors who are mostly interest-only borrowers.
If that group form the view that house prices, it's not necessarily that they're going to fall, but just that they're not going to keep on going up, if they all sell at the same time, that's the kind of environment where house prices would fall quite significantly.
Investors, if they see properties beginning to slide, probably will walk away earlier and may be prepared to take a capital loss if they can switch into other asset classes.
But Deloitte rejects the notion that all investors will head for the exits at the first sign of trouble.
Many investors these days are actually first-home buyers who simply choose the investment path as the path to take out their first home property rather than be an owner-occupier.
And then, of course, the banks have a rescuer no other business in the country can count on if it all goes pear-shaped. The Reserve Bank, backed by who else but the taxpayers.